Welcome to the webinar for SiMSCI Outlook for the fourth quarter of 2012. I'm Zhen Hui, Investment Analyst with Phillip Futures. Disclaimer. This presentation is solely for educational purposes. Do not treat it as an investment advice. In the next 20 minutes or so, I'm going to bring you through a brief introduction on SiMSCI, market review, and market outlook for the fourth quarter of 2012. The MSCI Singapore Free Index, also known as SiMSCI, is a free float adjusted market capitalization weighted index that gauges the equity market performance of Singapore securities listed on Singapore Stock Exchange. It is made up of 32 component stocks, out of which Singtel, DBS, UOB, and OCBC account for the largest weightage. 3 out of 4 major component stocks of SiMSCI are banks. When you look at the sector composition, financial sector accounts for the largest pie of the index weightage at 49%, followed by industrials at 26% and telecommunication services at 11%. Financial sector includes banks, real estate firms, and stock exchange. For those of you who are more familiar with Straits Times Index, SiMSCI is actually quite similar to STI, which is made up of 30 component stocks. The top 3 sector exposures for both SiMSCI and STI are financials, industrials, and telecommunication services. The slight differences between the two indices lie in the exact weightage of specific sectors and component stocks that make up the indices. SiMSCI has a slightly higher weightage in financials and telecommunication services, while STI has a slightly higher weightage in industrials. Additional stocks in SiMSCI include Ascendas REIT, Keppel Land, NOL, Hutchison Port Trust, Costco Corp Singapore, UOL Group, and Yangzijiang Shipbuilding. Missing stocks in SiMSCI compared to STI are Jardine Strategic, SIA Engineering, Jardine Matheson, Hong Kong Land Holdings, and IHH Healthcare. When you compare the performance of SiMSCI and STI, you will notice that they tend to move in tandem. The correlation between the two indices over the span of the last 2 years is 0.88, which is considered as quite high. In futures market, SiMSCI has more liquidity compared to STI. Hence, SiMSCI futures could be a better instrument to express an investor's view on equity market performance of Singapore. Under market review, we are going to cover 2 key things, namely Singapore's year-to-date outperformance over regional composite index and key macro drivers of equity performance over the last 3 quarters. This chart shows the equity performance of Singapore in red, which is proxied by SiMSCI, ASEAN in green, which is proxied by MSCI Southeast Asia, and Asia ex-Japan in blue, which is proxied by MSCI Asia ex-Japan. Of particular interest to us is Singapore's outperformance over Asia ex-Japan and Southeast Asia. Except for brief periods, the red line has stayed above the other 2 lines for most of 2012. Singapore, being the only AAA rated country within ASEAN region, is considered as a relatively safe haven despite its earning volatility. Impeccable corporate governance, relatively benign political and policy risks, and healthy banking system further enhance the safe haven status. Hence, it is not surprising that Singapore equity market outperformed the regional composite index during the defensive rally period, which was characterized by lower beta defensive names doing better. The first quarter rally was spurred predominantly by ECB's massive 3-year longer-term refinancing operations, LTRO, orderly Greek debt restructuring, and positive US labor markets. The cheap 3-year loans offered by ECB to the banks through LTRO broke the vicious cycle dynamics affecting the Eurozone area. This has also cut down on the threat to the economies with close linkages to the Eurozone banks. LTRO, coupled with a restructuring of privately owned Greek debt, ensured that there were no financial casualties large enough to undermine global financial markets and reduced the strains on the periphery sovereign bond markets. With diminished worries that the risk scenario of significantly slower economic growth unfolding, equity market rallied. In the second quarter, markets sold off as investors took profit in the face of increasing risk of extreme scenario playing out in the Eurozone. Under the extreme scenario, Greece could potentially exit Eurozone in a disorderly fashion, culminating in increased risk aversion, dragging Spain and other periphery nations into declining investor confidence on their credit worthiness. Potential large external shock to Asian economies, emanating from bank runs and capital outflows in Eurozone area, could result in severe slowdown in global growth. The Greek election results in June have alleviated worries about Greece exiting the Eurozone in the short run, but this has done little to improve the situation of other periphery economies, such as Spain. Risk sentiment recovered and market rallied in the third quarter as aggressive policy actions by major central banks around the world removed perceived tail risks in the near term. While the outright monetary transactions (OMT) by ECB is not a remedy for all of Eurozone problems, it has substantially reduced the tail risk of imminent Eurozone breakup and the ensuing global financial crisis. The Fed's QE3 comes with an open-ended commitment to extend the policy until the outlook of labour market has ameliorated substantially. This has provided some cushion against the negative impact of fiscal cliff on the US economy. Fiscal cliff refers to the simultaneous tax hike and spending cut in 2003, which could tip US economy back into recession. Under market outlook, we're going to cover three key themes, namely sluggish global growth weighing on corporate earnings in Singapore, earnings trend, and historical performance of SiMSCI during quantitative easing. Although aggressive policy actions from major central banks in the world have reduced the tail risks, particularly the ones associated to Eurozone, the timing of global growth picking up again remains uncertain. Manufacturing Purchasing Managers Index is a leading economic indicator which tends to give early signal of economic slowdown or economic acceleration before it occurs. A reading above 50 is indicative of an expanding manufacturing sector, while reading below 50 is indicative of a contracting manufacturing sector. The current manufacturing PMI for China, Japan and Eurozone is below 50, which is indicative of a possible economic slowdown. The recent uptick in the US manufacturing PMI to above 50 could provide some measure of optimism. However, the underlying trend seems to suggest a lower manufacturing PMI reading in the second half of 2012. This does not bode well for the global economy. With most of the manufacturing PMI still below 50 mark, we are unable to identify a major economy with bright sparks to engineer a global economic recovery in the fourth quarter, except US. The outlook of US is not particularly positive, as it could be restrained by the upcoming fiscal cliff. With global economic weaknesses as the backdrop, the fiscal tightening measures would reinforce the prevailing frailties of the economy of the United States and may culminate in significantly deeper reductions in consumption, investment, and hiring decisions. Due to the immense potential impact, we expect Congress and the White House to work together after the election to avert the effects of growth-inhibiting fiscal tightening. The recent downward revision on global economic growth by the International Monetary Fund lends credence to the global slowdown story in the last quarter of 2012. Given the fact that exports make up more than double the size of Singapore GDP and the export product mix that is skewed towards more cyclical sectors, Singapore's economic growth will be adversely affected by global economic slowdown. Recent data of Singapore's manufacturing PMI also narrates a similar slowdown story. This slump in external demand has eaten into manufacturing output and lowered profitability of manufacturing companies. The slowing growth momentum in manufacturing is already showing up in the recent data of non-oil domestic export, NODX, and industrial output. After a robust year-on-year growth in the beginning of the year, both data series are venturing into negative territory, and this could herald a rough patch ahead for the manufacturing sector. The effects of slowing global demand are not only confined to the contribution to growth from net exports. Concerns about future demand and general negative sentiment in corporate sector could result in contracting manufacturing investment as companies cut down on installing new capacity and postpone purchasing decisions. Consumer demand would also be under pressure, and there could be a negative spillover effects into other segments of the economy. Furthermore, while other central banks in the region eased monetary policy, Central Bank of Singapore maintains its tightening stance to combat inflation. By retaining appreciation bias in Sing dollar, this could result in erosion in competitiveness of Singapore's export. Although growth prospect is lackluster, not everything is doom and gloom. With major central banks pursuing ultra-loose monetary policy, this means increased liquidity in global financial markets and could be supportive of risky asset prices despite the anemic economic growth. Even if global equity prices continue to rally on the back of loose monetary policy, we are of the view that Singapore is likely to underperform the regional countries within this region. Countries with domestic consumption making up a larger part of the economic contribution, such as Indonesia, tend to hold up better in a scenario of slowdown to external demand. Considering the less rosy outlook for global economic growth for the last quarter of 2012, it is likely that companies may undergo a series of earning downgrades over the next few months, and companies' earnings may fall short of market expectation. This will inevitably weigh on the performance of SiMSCI. In the next few charts, let's explore the relationship between earnings surprises of component stocks of SiMSCI and the price action of SiMSCI. A positive earnings surprise occurs when a company reports earnings that exceeds market expectation, while a negative earnings surprise occurs when a company reports earnings that fall short of market expectation. The blue bar above the zero line will keep track of the number of component stocks that report positive earnings surprise on a weekly basis. The red bar below the zero line will keep track of the number of component stocks that report negative earnings surprise. In the first quarter, the number of component stocks that reported positive earnings surprise is higher than the number of component stocks that reported negative earnings surprise. Hence, as the earnings season progresses, SiMSCI increased steadily. In the second quarter, the number of positive earnings surprise is roughly the same as the number of negative earnings surprise, except for the week circled in red, where the number of negative earnings outnumber the number of positive earnings. SiMSCI coincidentally plummeted during that period. In the third quarter, the number of positive earnings is roughly the same as the number of negative earnings, and SiMSCI held up pretty well during that period. If the actual earning of the fourth quarter falls short of expectation, this could spell weakness to the equity index performance for the fourth quarter. This chart shows how SiMSCI has performed 100 days after the announcement of quantitative easing. Red line shows the performance of SiMSCI after QE1, while blue line shows the performance of SiMSCI after QE2. In absolute terms, market performance has differed historically. SiMSCI rallied after QE1, but edged down after QE2. Part of the reason to account for the difference is because QE1 happened at close to the bottom of earnings per share momentum, while QE2 came close to earnings growth peaks. This chart shows how SiMSCI has performed relative to MSCI Asia ex-Japan 100 days after the announcement of QE. A value above zero means SiMSCI outperforms MSCI Asia ex-Japan, while a value below zero means SiMSCI underperforms MSCI Asia ex-Japan. On a relative basis, SiMSCI has underperformed MSCI Asia ex-Japan in both QE1 and QE2. With slowing exports and domestic growth, coupled with strong inflation, we do not think the current round of QE would play out differently. In a nutshell, SiMSCI is likely to underperform other regional indices. While QE3 could provide room for a tactical rally, its sustainability would hinge on an improvement in economic growth outlook, which appears less likely after the recent growth downgrade by IMF. Sluggish global growth is likely to weigh on Singapore as investors are likely to take profit on the back of strong year-to-date performance in SiMSCI and reposition into markets which are less dependent on exports. Taking into consideration of the possible earnings disappointment, we tend to have a more cautious view of the potential upside of SiMSCI. Furthermore, higher beta markets tend to perform better than SiMSCI historically during quantitative easing. For more information on the trading strategies appropriate for this kind of market environment, feel free to approach any representatives from Phillip Futures for a further discussion. This concludes the webinar. Thank you for your time. I'm Zhen Hui, investment analyst with Phillip Futures. Stay tuned for more webinars.